I'm Shae Smith, Weekend Editor of Money Morning and Tech Insider. In this video and the four that follow, I'll introduce you to the basic concepts of technical analysis. Today, we'll look at the most important aspect of technical analysis, price action and how technical analysts observe price changes. But first, what exactly is technical analysis? Simply put, it's a method of using charts to study a particular share, index, commodity, or foreign exchange. Price charts are compiled based on past data, and technical analysts use this to try to predict future events. Some technical analysts, or chartists as they're occasionally called, feel technical trading is a way of removing the noise from the stock market. That is, eliminating the news stories and reactions to macro events in the wider market, which can cloud your judgment when analysing a stock. In order to do this, technical analysts study price charts with one basic assumption. Unlike fundamental analysis, where an analyst will look for intrinsic value to see if a stock is under or overvalued, chartists believe that a stock price has already factored in all of the available information. Now, depending on your view of the market, charts can display price action by the second, minute, or hour for the short-term trader. Or if you're analysing a security for the long term, you may want to look at daily and weekly charts to see more of a long-term trend. Using charts can help you determine an entry and exit point. For instance, they can help you decide when to buy a share, create a stop loss, or a take profit order. To do that, you'll need some basic methods of technical analysis, which I'll explain to you today. So let's get started. The price charts I'll discuss today are the three most common types. They are line charts, bar charts, and candlestick charts. A line chart is simply a line that shows the closing price of a security over various periods. This chart shows the daily closing price for a stock. On the other hand, a bar chart contains individual lines that show four key price points over a time frame. There's the vertical lines, which indicates the high and low for the day. On either side of the vertical line are two small horizontal lines. The one on the left is the price when the time period began, and the one on the right, that's when the time period finished. So if you were looking at a daily chart, the open and close lines would reflect the price when the market opened and the price when the market closed. If it was an hourly chart, the time is the start of the hour and the end of the hour. This is probably the most used chart type, as you can easily see the open, high, low and close of a stock at a glance. And finally, there's the candlestick chart. This one is similar to a bar chart, however the vertical line is wider in some sections. This width demonstrates the difference between the open and close price. Candlestick charts usually have a true colour display. Generally, you'll find a combination of either red and black or green and red. Where red is displayed, it means the stock traded down for that period. However, green or black are used to signal an up period. That is, the stock closed higher than its open price. The spikes on either end of the wide vertical lines inform you of the security's high and low for that time frame. So that's the basic features of a technical analysis chart. It should give you some understanding of what those lines mean. In the next video, I'll explain some of the tools traders can use to help determine specific buy and sell points for share trading. As we get into those details, that's really where technical analysis can help you become a successful trader. I'll see you next time.